You can either divide 1,25,000 in this ratio of 6:5:5:4 or 30%, whatever it is. Yeah, so I'll just write the ratio here because it's easier to write. So we have already done this part. Now to divide this, okay, again I'll just explain this since I've written it here. Unmarked applications take your total subscriptions. Unmarked applications also come from the public. The total subscriptions or applications that have come from the public are 90,000 minus 80,000. How did I get this 80,000? 80,000 are basically the marked applications. So if I put these four figures together, 24 plus 20, 44 plus 12, 46, 56, 56 plus 24 is 80. You get 10,000. To that 10,000 you add firm underwriting, which is 25,000. Okay. So after doing that calculation, we will have 10,500. This comes to 8750. This comes to 8750. And this comes to 7,000. So we minus this. If I minus this, it will be 13,500 minus 10,500 will be 3,000. This will come to 2,500. This will come to 10,500. And here we have a surplus. We have a surplus of 6,000. We have a surplus of 6,000. That is, its actual liability of D had come to 1,000, but he has got unmarked applications plus firm underwriting of 7,000 in his favor. So his surplus is 6,000. Now this 6,000 we need to divide among all the underwriters. So I say less surplus of D allocated to A, B and C in the ratio of gross liability. What is the ratio of gross liability? 6:5:5. 6:5:5. Okay, so if I divide 6,000 in that ratio, I will get 2250. Here it will be 1875 and 1875. And this will be plus 6,000. Whatever it is, these three figures put together have to come to 6,000. So 2250, 1875, 1875. Now this comes down to 3,000 minus 2250 will be 750. This will be 2,625. And here we'll have quite a big amount, 8625. That means D has to take up nothing. We'll just have to check whether we are correct. 750 plus 625 plus 8625 has to come to 10,000, and it does come to 10,000. Okay, if you put these two together, you get 1250. Sorry, 9250 and plus 750 will be 10,000. So basically we are correct. So we call this liability as per agreement. Call this liability as per agreement. What is the meaning of liability as per agreement? The remaining shares that have not been taken up by anybody, the underwriters are going to divide in this way. That means D does not have to take up anything. Okay. And then we do what we try to find out are the total shares to be taken up. So we say add firm underwriting. Add firm underwriting of each one, which will be 4,000, 6,000, nil, because I think C doesn't have anything, and this would be 15,000. So the total shares that have to be taken up, that's a net liability. Net liability. Here in case of A, it is 4750, which means 750 were as per liability as per agreement, 4,000 what he had decided in advance. Here it is 6625, here it is 8625, and here it is 50,000. Okay, so this is how the first statement is done. So we have found out how many shares have to be taken up by each underwriter. Why we do this towards the end? Just to know the total number of shares that each one has to take up. So as per their agreement, which they have to take up, where in case the public do not subscribe, A has to take up, B has to take up, C has to take up, doesn't have to take up anything. If you solve under benefit given, this thing may totally change. You surely won't get the same figures, most likely. Okay, if you solve under benefit given, most likely this figures will totally change. Maybe D may have to take up something, somebody else may not have to take. Okay, so if you want to experiment, you can do it by yourself. The next statement showing amount due to slash due from underwriters. Statement showing amount due to slash due from underwriters. So again, we will have to add a column here. So we have the same thing. Particulars A, B, C, and D. So like I said, we start this statement with the answer of the previous statement. So we say number of shares to be subscribed by the underwriters. The whole point of preparing this statement is to know finally who has to pay whom, whether the company has to pay the underwriters or the underwriters have to pay the company. Number of shares to be subscribed by the underwriters, we will get this from here, the answer here, 4750. Then we have 6625. Then this is 8625 and 15,000. Okay, I close this because I said till here it's in shares, but from the next thing onwards, it's going to be in figures, in rupees. Okay, so these are the shares that have to be taken up by each of the underwriters. Next, we calculate the amount on these shares. We say amount payable at the rate of rupees 50 per share on application. That means if the underwriters are taking up this share, they express their intent at the application stage. And if you express your intent, you have to pay whatever is due on application. In the last problem, we took the entire 10 because the entire 10 was asked on application. In this problem, they have to pay only 50 on application. So amount payable at the rate of rupees 50 per share on application. So if I multiply 50 by this amount, I will get 2,37,500. In case of B, it will be 3,31,250. In case of C, again 3,31. Sorry, case of C, it will be 4,31,250. 4,31,250. And in case of D, it will be 7,50,000. How did I get these amounts? Multiply 50 with all these. You will get these amounts. Okay. Now we come to something very important which we had discussed also in the last problem. This is a total amount that is payable by the underwriters on these shares. Okay. But we know that even before the public issue was made, the underwriters decided that they are going to take up a specific number of shares on account of firm underwriting. So if they had decided even before the public issue, that means they must have paid an amount on application on those shares under firm underwriting then itself. Okay, so from this amount, from this total amount, we need to minus the amount that has already been paid by the underwriters on firm application. Okay, so we say less amount paid by underwriters on firm application. You need to say amount paid on firm application. It's understood by underwriters because nobody else takes up that. On firm application at the rate of rupees 50 per share. Okay, so basically what I have to do is I have to take 50 and multiply by each one's firm underwriting, because for these shares they're already paid in advance. Okay, they're already paid. How do I know they're already paid? Because the moment they express their intent that they're going to take up so and so number of shares, they have to pay for those shares, the application money. So it will be 50 into 4,000, which will be 2 lakhs. Here it will be 50 into 6,000, which will be 3 lakhs. Here it will be nil because there's nothing. 50 into 0. He has not taken up anything under firm underwriting. And for D, it will be 50 into 15,000, which will be 7 lakhs 50,000. Okay. So balance, very important now. Balance payable by underwriting. How much is the balance? In case of A, it's 37,500. In case of B, it is 31,250. In case of C, he has to pay the entire amount. He has not paid anything. So 4,31,250. In case of D, D does not have to pay anything. So if you look here, okay, liability as per agreement. Basically, what they are paying here is 50 rupees into all this. If you take 50 and multiply by 750, you will surely get this. 50 into 625, you will get this. 50 into 8625, you will get this. 50 into 0 is this. That means D does not have to pay the company absolutely anything. That means only the company will have to pay D. Okay. So next, what we calculate is what the company has to pay the underwriters on account of underwriting commission. What the company has to pay the underwriters on account of underwriting commission. So I say less underwriting commission. Okay, so I calculate underwriting commission for each one: A, B, C, and A, B, C, and D. Okay, so that's equal to always underwriting commission on gross liability, the initial responsibility they are taken. Okay, on gross liability. So 37,500 in case of A. Now be very careful here. Always on the issue price of shares. I keep repeating this. Underwriting commission is always paid on issue price of shares, and the issue price of shares is what? 100 rupees. Okay, 50 is payable on application, but eventually the entire 100 will be paid. Now, in case it was issued at a premium, say of 25 rupees, this would have been 125. Okay, but right now it's issued at face value, so we're just going to take 100 rupees. Always on issue price of shares. Underwriting commission always on issue price, so 100 into the rate of commission, which is 2%. Here, it's given to us. 2% is the rate of commission. Okay, then for BC, I just have to change the gross liability. So here for B, it will be 31,250, C also 31,250, and D it is 25,000. So this is 31,250, 31,250, and this is 25,000. Okay, so if I do these calculations, I will get, in case of A, it will be 75,000. In case of B, it's going to be 62,500. In case of C, it will also be 62,500. And in case of D, it's going to be 50,000. Okay, that means these are the commission that the company has to pay the underwriters. These are the amounts that the underwriters have to pay the company. This is the amount that the company has to pay the underwriters on account of commission. So finally, we see amount due to / due from underwriters. Okay, now we have to see who has to pay who. In case of A has to pay 37,500, company has to pay 75,000. So basically the company has to pay Okay, so for since we are in the books of the company has to pay, I put it in brackets, it will be 37,500. In case of B again, B has to pay the company 31,250, the company has to pay B 62,500. So the company will have to pay B how much? 31,250. In case of C, C has to pay this much and the company has to pay. So basically the company will receive from C and the company will receive an amount of 368,750. Okay, so only from C the company is receiving, and here again D does not have to pay the company anything. The company will have to pay D 50,000. The company will have to pay D 50,000. Is that clear, everyone? Anyone has any questions? It's exactly like what I did in the last class. Only thing we had a slight difference here of 50 rupees. Why I took 50? Because we are, even last time I mentioned, we are only concerned with what is received on application. Because that's where you express your intent to purchase the shares. Any questions, students? Anyone has any questions? Okay. I will go on now to the journal entries. What else they have also asked is journal entries that you would make in the books of the company. So we don't know a name of the company. So I'm just going to say journal entries journal entries in the books of the company. We don't know the name of the company, so I will just write it as company. Particulars, particulars, debit and credit. Particulars, debit and credit. Now before I start, I'll just explain what we are going to do in this journal entries. Basically, we have to pass journal entries when for a share issue, and you have all learned these journal entries in the past. Whenever shares are issued, what is the sequence of entries? Okay, what is the sequence? Now we don't have to go and pass up till a lot first call and whatever second call. We just have an application stage right now in this problem. So we are going to show the application stage. Basically, what happens in these two statements. We are just going to show what happens in these two statements. The amount received from the underwriters, underwriting commission paid. The amount received from the public, the balance payable by underwriters, the underwriting commission paid, and finally who has to pay. That's what we are going to show. So it is just around 5 to 6 entries depending on the problem. Okay. Now, normally when shares are issued, what is the first entry? Normally when shares are issued, what is the first entry? Can anyone tell me? When a share issue, when a company floats an issue, what is the first entry? Quick. What is the first entry? That's what we are going to pass right now. Bank account, the first entry, bank account debit to share application account and share application account debit to share capital account. So we're going to say bank account debit to share application. Now the question is how much has been received? Okay, how much has been received? We're saying bank account debit to share application account. How much has been received? So we need to do that calculation. We need to do that calculation of how much has been received. Okay. Now, how many applications have been received from the public? Look at the problem and tell me how many applications have been received from the public. What is the meaning of application money? Application money that you have received, okay, either from the public or on account of firm underwriting. How many people have subscribed to the shares? You can even look at this. The total issue that was floated was 1,25,000. Out of 1,25,000, underwriters agreed to take up 25,000 well in advance, and the public finally subscribed to 90,000. So basically, the application money has been received on 90,000 and 1,25,000 shares. So when we are taking firm bank account, it's going to be 90,000 plus 25,000, which is equal to, if we put that together, we will get 1,15,000 into the application money, that is into rupees 50. Into rupees 50. Okay, I've just done that calculation here. So bank account debit 90,000 into plus 25,000. 90,000 is the total applications received from the public. 25,000 is the firm underwriting, equal to 1,15,000 into rupees 50. That's into how much has been received on application. Okay, this the total amount. These shares 10,000. This 10,000 did not come with the application. This 10,000 was divided later. That we are going to show a little later. Okay, that we are going to show a little later. So what I'm going to say, the total here comes to 57 lakhs 50,000. 57 lakhs 50,000. Okay, being application money received on 1,15,000 shares, being application money received on 1,15,000 shares at the rate of rupees 50 per share. You can also show 90,000. I think I'll show that 1,50,000 shares, 90,000 shares, 90,000 from public, and 25,000 on firm application at the rate of rupees 50 per share. At the rate of rupees 50 per share. I've just kind of narration normally describes the transaction. Application money received on 1,15,000 shares. I've just further explained 1,15,000. How I got 1,15,000. 90,000 is from public subscription and 25,000 on firm application, and they've all paid rupees 50 per share. Anyone has any questions with regard to this entry? Anyone has any questions? Okay, so this is our first entry. Now the second entry is normally share application account debit to share capital. So I'm going to write that right here. Share application account debit. Share application account debit to. You'll wonder why I've left that space. I will explain that. To share capital account. You can say equity share capital account. Share application account debit to share equity share capital account. Now, in our share application account, we have received how much? 57 lakhs 50,000. We have received 57 lakhs 50,000. In our equity share capital account, how much are we supposed to have? How many shares were floated in total? They had floated 1,25,000 shares. Okay, 1,25,000 shares, and they appointed underwriters so that each and every share is being subscribed to. Even if the public does not subscribe, the underwriters take up shares and each and every share is subscribed. That's why the underwriters were appointed. So basically, when we are transferring to share capital account, we have to transfer 1,25,000 into rupees 50. Because we have floated 1,25,000 shares and we expect money on the entire 1,25,000 shares. Okay, so 1,25,000 shares into rupees 50. If you do the calculation, it comes to 62 lakhs. 62 lakhs 50,000 shares. Now there is a problem here. The application money received is only 57 lakhs 50,000 shares, but we have transferred 62 lakhs 50,000. Why have I transferred 62 lakhs 50,000? Because I have come out with an issue of 1 lakh 25,000, and I expect each the company. When I say I, the company expects each and every share to be subscribed to. How can they be so sure? They have appointed underwriters. Okay, but right now in the share application fund or the share application account, we have only 57 lakhs 50,000. We are expecting 62 lakhs 50,000. That's much more. Who's going to do this balance? Or from where is this balance going to come? From where is this balance going to come? Can anyone tell me? From where is this balance going to come? Quick, quick. I don't have much time. From where is this balance going to come? Who's going to do this balance? See, how did this 57 lakhs 50,000 come about? Public and firm. Okay, but who's going to do this balance?
It's the underwriter.
Very good. The underwriters are going to do. And if you check this previous statement, okay, these amounts here 37,500, 31,250, 4 lakh, 31,250. This is that balance that is payable by underwriters. I will just show it here. So basically, A has to pay 37,500. So I'm going to say A's account debit. A's account debit. A's account debit. Similarly, I'm going to say B's account debit. B's account debit and C's account debit. Okay, so if A's account is 31,250, B's account is how much? How much B has to pay? Sorry, A is 37,500, B is 31,250, 37,500, and C is 4 lakh 31,250. Somebody, if you all have a calculator with you, put this together and you will surely get 62 lakhs 50,000. You will surely get 62 lakhs 50,000. Okay, that means the balance that has not been taken up by anybody has been taken up by the underwriter. So how did I get this balance? This balance has come from me. So if you're solving the problem, you can just make a note that these three amounts are the balance payable by underwriters. This is a balancing figure basically. So what you do is see how much you have in your share application. Share capital will have the actual issue that is floated. And you expect each and every share to be bought because you have underwritten the issue. So if the public do not buy, the underwriters have to take up. And the balance, if there is a balance or there's a difference, if any, will be taken up by the underwriters. So first entry is you show how much has come in through public subscription and firm application. Second entry, you transfer it to application. Balance, if any, is payable, going to be payable by the underwriters. Okay. I'll go to the next entry, then we can come back to this. The next entry is we need to record the underwriting commission. We are doing the entries in the books of the company. The next thing that we do is we have finished this. The next thing that we do is this. We record the underwriting commission that is payable. Okay. So since we are in the books of the company, underwriting commission becomes an expense for the company. Okay. So underwriting, debit the expenses, underwriting commission, account, debit to whoever the underwriter has to pay to A's account. All the four underwriters, they will have to pay underwriting commission to A, to B, to C's account and to D's account. So we will have to check how much they have to pay each of them. Here 75, 62, 500, 62, 500 and 50,000. So that will be, normally it would have been underwriting commission to cash, but here we are showing it as payable because finally they will adjust and then we will show it as buy bank or buy cash. Okay. Right now we are showing as underwriting commission payable. So here it will be 75,000. Here it will be 62,500. 62,500 and 50,000. So the total underwriting commission comes to 2,50,000. Company has to pay a total of 2,50,000. Okay. Oh, sorry, I forgot to put the narration here. Being share application money transferred to share capital and the balance adjusted towards underwriters. And the balance adjusted towards underwriters. Okay, that's what we have done. We have transferred the share application to share capital and the difference has been adjusted towards the underwriters. That means they are going to. This is being underwriting commission payable recorded. Being underwriting commission payable recorded. Okay, so what we have checked now here, what we have done, we have seen that A owes this much and the company owes this much to A. Okay, so finally we see the last part, who has to pay who. Okay, so either the company has to pay the underwriters or the underwriter has to pay the company. So in case of A, B and D, in case of A, B and D, the company has to pay the underwriters. If you see all these amounts, that's why I put it in brackets. Whenever the company has to pay the underwriters, we put it in brackets. Okay, so the company has to pay the underwriters. So it will be A's account debit, B's account debit, D's account debit to bank. A's account debit, B's account debit and D's account debit. Why I took all these three? A's account debit, B's account debit, D's account, because all these, in case of all these three, the company has to pay. So we will say to bank. Why to bank? Because money is going out. To bank. How much does the company owe each of these three? Here in case of A it is 37,500. In case of B it's 31,250. Here it is 50,000. So 37,500. In case of B, it is 31,250, and in case of C, it is 50,000. And to bank will be the total that they have to pay all these three, 1,18,750. Okay, so I say being the amount paid to underwriters, after adjusting underwriting commission. After adjusting underwriting commission. Okay, so what we have done right now, we have just seen how much the company has to pay. And in case of C, C has to pay the company. The company is receiving money from C. So the entry will just be the opposite. It will be bank account debit to C's account. Because money is coming in from C. So it's going to be bank account debit. Bank account debit to C's account. Bank account debit to C's account, and how much is coming in from C? Only C has to pay the company 3,68,750. After the adjustment, 3,68,750. 368,750. So we say B, amount received from underwriter after adjusting underwriting commission. Being amount received from the underwriter after adjusting the underwriting commission. So I'll just go to the journal entries again. First journal entries show the application money received on account of firm underwriting and from the public. Next one, transfer that application money to share capital, and the balance has to be that balance payable by underwriters. You transfer the entire issue that has been floated to the public, only the public issue. Okay, and the balance will come from the underwriters. Next, you record the commission that is payable to them, and then you see who has to pay whom. If this entry comes first, there's no problem. Okay, if you show the receipt entry first, there's no problem. Either of these can be interchanged, whatever it is, but both have to be shown. You can show that the company is receiving from which underwriters, and then you can show company is paying to which underwriters. Any questions, students?